Welcome everyone back to Pete's Investing Updates. We review the weekly progress of a sample of blue chip stocks from Australia, the US and Europe. And in this week's summary, as well as looking at those specific stocks, we're going to be comparing the results of a daily chart versus the intraday charts to see if it's worth changing our strategy from a 15-minute chart time frame. If you want me to review a share price, put it in the comments and I'll cover it in a future video. As always, click on the subscribe button, the notification bell, and like this video to support the channel. First, let's review the channel playlists, and this is where we review the share prices. And from this video, we post them in this playlist. We also do a weekly update on the indices from across the world. And we also talk about the strategies in this playlist. And some of those strategies include the simple trading strategy we follow, the average down process, and some money management ideas. But as always, don't forget, we're not offering financial advice. It's only an educational video series to better educate you. So let's get stuck straight into the results. So what I've done here, this is your typical rolling 17-month, 15-minute time frame of the blue chip shares we're tracking each week. This just shows the codes for those companies, dividend yields, and the ex-dividend dates of when they're payable. So that hasn't changed. Again, this is a 15-minute time frame. This shows a profitability and the maximum drawdown for each of those. So the profitability, let's look at the Commonwealth Bank as an example. So in a 15-minute time frame, we've got the this is the price chart and this is our profitability chart. So we're showing here profitability over the roughly 18 months, or since the start of 2020, we've generated $1,081 in profits. And this shows you how many contracts were entered. And we're trading $2,000 lots for each entry. Here we've doubled up. So the price was entered here. We entered another lot of shares here. That shows the average down of that stock before it closed out at a profit there. These were all single trades with no averaging down. We bought a lot of $2,000 lots of stock there. Bought another lot there. And we closed out there. So you can see there on that little purchase from there, the price went down. We bought another lot of stocks there. We closed out at that point there. We closed out those two lots of. The first lot we bought just under 30 shares, or let's round it up to 30 shares. That's just the program uses decimals. And the second lot of shares we bought 27 shares. We closed that out. You can see there the profitability of that trade. This includes brokerage. Our baseline is 100,000, so we open up $100,000 here. So you can see there, profits made $892 from a starting point of $331. So we made about $500 profit in those few months of trade there in a 15-minute time frame. But overall, for the roughly 18 months, we've generated $1,081. So that's what $1,081 there shows. The maximum drawdown, 531. That is simply the highest point of profitability down to the lowest point. So if you use a ruler, to draw down from, let's say from that area down to there, about $509. Just that's on the manual drawing of it. But the actual real calculation, if we do a detailed report, is 531. That's very close to. Again, just eyeballing it there, that's what that drawdown shows. 531 as a drawdown. What this shows here is the profit over drawdown. So 1,081 over 531 is 204%. It just shows you the higher that percentage, the better. So in other words, you want to have a better percentage of profit. So what it's done here is I've always stocks measured on the 15-minute time frame. Again, these are a mixture of US dollars, Australian dollars, and euro. We've generated 7,200, let's call it dollars, or 52% return of every transaction entered was $2,000, and a drawdown of 7,700, so about 93%. Then we did the same result for a daily chart. So let's look at the daily comparison. Again, this goes back to the start of 2020, similar to our 15-minute time frame. Here we're trading on the daily frame. We entered our initial entry there. That's where we entered there on that price. The price went up, then went down due to COVID. We entered another lot of 33 shares there. Actually we missed it. We entered 32 shares there. It's another lot of 33 shares there. Tracked sideways for a few months, and at the start of this year, we closed out those 3 entries there at a slight profit of 1,669 from 100,000. So made about $1,669 in that trade over the course of the year almost. It reopened here, averaged down another lot there, and it closed out there. So overall, in that time frame, it made 21.66. And that's what that 21.66 does. And it shows you the return on the $2,000, 53% return. And that shows you the drawdown of $207, which is very similar to the 15-minute time frame. So in summary, what it's done here, and I'll explain this chart, these are the profits generated over the 15-minute time frame, and these are the profits generated over the daily time frame for the similar period, for the similar strategy. The drawdowns were a bit more on the daily time frame, and the profits were a bit less on the daily time frame as well. Hence, the higher the percentage here overall is a better result than the lower percentage. So what it's basically saying in summary, get to the end result. In summary, we're saying the high percentage returns works better on a 15-minute time frame because we're generating better profits on less drawdown requirements. That just gives you a calculation out on roughly on a per monthly basis, which is basically that 7,200 divided by 18. That's, in summary, it's basically saying the 15-minute time frame chart yields a better result using the stocks we traded. Let's look at the BHP as another example. So again, this is the 15-minute time frame. The other benefit of the 15-minute time frame, you get in and out of the trades more regularly, more often. Now, that might sound counterintuitive because you may want to stay in it for a longer term. Let's look at the daily time frame, for example. Here you got longer time frames in the market. So here, for example, you entered the market there with 56 shares, and it kept it for 1, 2, 3, 4, 5, 6, 7, 8, 9, about 9 months. Now, you might be happy with that. That's fine. But the benefit of doing it on a 15-minute time frame, it lets you come in and out of the trade. And the benefit of that is it gives you cash flow. So if you want to withdraw that money, those little trades, and you want to withdraw the money and pocket it or spend it, take it out of your account, that's the benefit of that, rather than having it tied up longer term. And now this may be short term for many investors, but again, depending on your strategy. If you want cash flow, I suggest using the 15-minute time frame. If you want to just sit on your money and grow your account over a number of years, by all means, trade the daily daily strategy. So again, not a huge difference on the daily strategy versus the 15-minute frame, but the main difference would be better profits slightly in this examples for these shares, and you're in and out of the market with better cash flow. Again, that's BHP on a daily versus BHP on a 15-minute time frame. Let's look at the next chart. It's Volkswagen. So 15-minute time frame again. You're in and out of the market a few times here as the market appreciated. Made a nice little profit on that one. Versus the daily time frame. We bought it once here, twice there, and a third entry there, just after COVID exited. Held all those contracts, all those shares for most of 2020, and we exited just when the market closed there. And we re-entered the market back here on Volkswagen. So again, 47.80 for Volkswagen on the daily chart versus 2012 on the 15-minute chart. You can see there, 47.80 versus 2012. So again, 267 profits over drawdown versus 176. Next, we'll look at Telefonica. Again, 15-minute time frame, you're in and out of the market multiple times throughout that roughly almost 18-month period. Versus the daily chart, you're in the market from almost day one, and you're still, in this case, you're still in it, and you're just breaking even above our 100,000 profitability. So you can see there on a daily chart, it's made 125 because it's gone below our $100,000 baseline, but on a 15-minute time frame, we went below here during the late stages of 2020, but we broke up after multiple contracts were entered in profit, and we were above and a better result on profits on that one. So for Telefonica, on a 15-minute time frame, it yielded €1,279 versus 125 for the daily. So again, if you want in and out of the market more frequently and better cash flow, the 15-minute time frame works better. Let's look at the next one. Here we're looking at JPMorgan. So again, 15-minute time frame. We got caught in a bit of a down because we got in at the top of before COVID hit in, broke in. We got into the market there. The market plunged. We entered another set of contracts there just before that lower spike again. We stayed in that with those 2 entries only, and we exited near the end of 2020. And again, we broke above our profitability of $100,000 baseline. But for the year, or for the last 18 months, we've generated 730 for the 15-minute time frame. Let's see what the daily chart has done. Again, daily chart, we came in once there, another time there before the COVID entered the market. Market fell off, entered a third level of contracts there, and we closed out in March this year. So this is not doing as badly as Telefonica, but it's still doing okay. 2147 versus 730 on a 15-minute chart. So there are sort of mixed results, 2147 versus 730, whereas this one generated a lot less versus Telefonica on a 15-minute time frame. But this just shows you the overall results. But again, it depends what your strategy is if you want to be in it longer term versus short term. Next, we look at Johnson & Johnson. Almost near the end, guys, just hang in there. So again, Johnson & Johnson on a 15-minute bounced around our 100,000 baseline for most of 2020, and it broke above after closing out this multiple trade here and closed out with 359, or currently 359 on a 15-minute time frame. On a daily, this performed a bit better. Most of 2020 were in that as well, so this one generated 811. So again, 811 on a daily versus 359 on a 15-minute. So much of a muchness for most of these charts. And lastly, Caterpillar. 15-minute time frame, fell below 100,000 profitability due to COVID back here. Multiple entries there, exited there with that profit, and a nice little run on the price chart for Caterpillar. Multiple 15-minute trades were entered, and we're sitting at 817 on Caterpillar for the 18 months. Whereas the daily, similar sort of entry and exit on the 2020 results, but because of the longer term time frame, and that you'll find it will work better returns if the price chart does this. But again, as I said before, it's very rare for price charts to do this. Generally, they will bounce up and down. Like in some of the other markets we saw, they do sort of go consolidate sideways before making some sort of advance or even a serious downturn. So this is quite rare. So if you can pick these charts, go for it. Stay in it, just buy and hold that stock. So again, this is just a summary of where we were. So depending on if you want in and out of the market, this is yielding better results over the drawdown, the profitability over the drawdown, 93%, the higher number percentage, the better, versus daily chart time frame, 6,900 versus 72 at 78%. So a lot slightly less better return than the 15-minute time frame. Okay, that's it for today. As always, click the subscribe button, the notification bell, and like this video to support the channel, and speak to you guys next week.